Welcome to Pro News Flash. Rumors of intervention have unsettled the dollar-yen. Let's dive into the latest developments. Fear has a way of magnifying things. The sharp fall in the dollar-yen during the run-up to the U.S. bank holidays sparked rumors of a new round of currency intervention. The rumors circulated widely in the market. At the turn of April and May, Japan spent around $73 billion on such interventions, but only to buy time, not to reverse the upward trend. Could the authorities have made a second attempt? The catalyst for the dollar-yen sell-off was a Reuters report by an insider about a change in the government's strategy. Previously, it had warned of intervention in the forex market, but it now has no intention of doing so. A currency intervention could have taken place at any moment, and speculators fell for it. They began to sharply unwind their net long positions, which had reached their highest level since 2007, by the week ending the 30th of June. This led to a marked strengthening of the yen. Evidence that Japan did not intervene is that the dollar-yen did not fall during trading on the 3rd of July, when U.S. markets were closed. A lack of liquidity at that time could have provoked a serious collapse. Furthermore, the U.S. dollar quickly returned to 162. It took more than a month and a half to reach 40-year highs, following the intervention in April and May. Fear quickly gave way to greed. Speculators are betting on a wide yield spread between the U.S. and Japanese debt markets. With the Fed set to tackle inflation and tighten monetary policy, the Bank of Japan's sluggishness is playing a cruel trick on the yen. Goldman Sachs has raised its year-end dollar-yen forecast from 155 to 165, citing a divergence in monetary policy. Pressure on the yen is being fueled by rumors that Sanae Takaichi will continue to press the Bank of Japan. It is said that the Prime Minister intends to fill the Board of Governors with doves. In addition, during a face-to-face meeting, she reportedly demanded that Kazuo Ueda pursue a policy in line with the administration's principles. Undermining the central bank's independence typically weakens the currency. The government was even forced to issue a denial. It dismissed press reports claiming it was encouraging low interest rates as part of its fiscal stimulus policy. Stay tuned to Pro News for further updates on developments in the financial markets. Like, share, and subscribe.